Hi, we are continuing example sums under valuation of goodwill in the average profits method. Let's go to example 4. Example 4. Bhaskar and Pillai are partners sharing profits and losses in the ratio of 3:2. They admit Kanika into partnership for 1/4 share in profit. Kanika brings in her share of goodwill in cash. Goodwill for this purpose is to be calculated at 2 years' purchase of the average normal profit of the past 3 years. The profits for the 3 years ended 31st March were, for 2017, there's a profit of 50,000. However, it includes profit on sale of assets of rupees 5,000. In 2018, there was a loss of 20,000, but this is including loss by fire of rupees 30,000. For 2019, there was a profit of 70,000, including insurance claim received rupees 18,000 and interest on investment and dividend received rupees 8,000. We are asked to calculate the value of goodwill of the firm and also the goodwill that has to be brought in by Kanika. So we'll begin with the solution. Now, though the profits or losses for the past 3 years has been given, we need to make adjustments to get the normal future maintainable profit. So we'll make a table like this. The first column for the year, the second column for the profit or loss, the third column for the adjustments that have to be made. And the last column for the adjusted profit. We'll begin with 2017. There was a profit of rupees 50,000. In 2018, there was a loss of rupees 20,000. And in 2019, again there was a profit of rupees 70,000. As far as 2017 is concerned, there is an abnormal gain from sale of assets of rupees 5,000. So we need to deduct rupees 5,000. In 2018, the loss of 20,000 includes loss by fire of 30,000. So we need to add back any abnormal loss. So we'll add back rupees 30,000. And in 2019, it includes insurance claim received of rupees 18,000, an abnormal gain, which we will deduct rupees 18,000. And interest on investment and dividend received of rupees 8,000. So it's interest on non-trade investments. So I will deduct that also. To arrive at the adjusted profit, for 2017, it's 45,000. For 2018, minus 20,000 plus 30,000, which is 10,000. And for 2019, it's 70,000 minus the total of 18,000 and 8,000, which is 26,000. So it's 44,000. Now we'll add up these profits total. $99,000. Therefore, average profits is equal to 99,000 divided by 3. We've taken 3 years, simple average, rupees 33,000. The formulae for goodwill. Goodwill is equal to average profits multiplied by number of years purchase. Which is equal to rupees 33,000 into, it says that goodwill is to be calculated at 2 years purchase of the average profits. So into 2, which is equal to rupees 66,000. This is the goodwill of the firm. Now, Kanika, who never had any share of profits, is suddenly going to get 1/4 share in the profit. So, if goodwill of the firm is 66,000, for getting a 1/4 share in profit, Kanika's share of goodwill, which she has to bring in, is equal to rupees 66,000 into 1 divided by 4, because she gets a 1/4 share in profit. So this is equal to rupees 16,500. So Kanika's share of goodwill is rupees 16,500. So we saw how to calculate goodwill when there were a few adjustments to be made to the given year's profits. Let's go to the next example. Example 5. Profits of a firm for the year ended 31st March for the last 5 years were, the 5 years and the profits are given. For the year ended 31st March 2015, profits is rupees 20,000. For the year ended 31st March 2016, profits 24,000 rupees. For the year ended 31st March 2017, profits are 30,000 rupees. For the year ended 31st March 2018, profits are 25,000 rupees. And for the year ended 31st March 2019, the profit is rupees 18,000. We are asked to calculate the value of goodwill on the basis of 3 years purchase of weighted average profit after assigning the weights 1, 2, 3, 4 and 5 to the profits for the year ended 31st March 2015, 2016, 2017, 2018 and 2019. So here we find that we need to calculate goodwill under the average profits method, but based on weighted average. So let's go ahead with the solution. We can prepare a small table, the first column being the year, The second column profits, third column weights, and finally the product. For 31/3/2015, the profits were rupees 20,000. For 31/3/2016, profits 24,000 rupees. For 31/3/2017, the profits are rupees 30,000. The 31/3/2018, profits rupees 25,000. And finally, for 31/3/2019, the profits are 18,000. We'll assign the weights. 1 goes to 2015, 2, 3, 4 and 5 and so on till 31/3/2019. The product column, the second column into the third column. The first item 20,000 into 1, 20,000. 24,000 rupees into 2 is 48,000. 30,000 rupees into 3, 90,000. 25,000 rupees into 4, 1 lakh rupees. And 18,000 rupees into 5, 90,000 rupees. Next, let's get the sum of the weights. Total of weights is 15. We'll get the sum of the product. It's 3,48,000, the sum of the product. Therefore, weighted average is equal to the sum of the product, which is 3,48,000 divided by 15, is equal to rupees 23,200 rupees. So this is a weighted average. Let's go on to calculate goodwill. The formulae for goodwill. Goodwill is equal to the average profits into number of years purchase. The average profits, the weighted average 23,200 rupees into the problem. It's given that it is 3 years purchase of weighted average profit. So we'll multiply by 3 and we get the value of goodwill of the firm as 69,600 rupees. So this is a goodwill of the firm, rupees 69,600. So we've done an example where we have to find out the value of goodwill using average profits method but based on weighted average. So for this we prepared a table with year in the first column, the profits in the second column. We assigned the weights in the third column. And the final column, product column, was the profits column, second column into the third column. Then we ascertain the sum of the weights and the sum of the product. The weighted average is equal to the sum of the product divided by sum of the weights. And to get the goodwill, we took the weighted average and multiplied by the number of years purchase. Let's go to next example. The final example, example 6. Calculate goodwill of a firm on the basis of 3 years purchase of the weighted average profits of the last 4 years. The profits of the last 4 financial years ending 31st March were, for 2016, it's rupees 25,000. For 2017, it's rupees 27,000. For 2018, it's rupees 46,900. And for 2019, it's rupees 53,810. The weights assigned to each year: 2016 it's 1, 2017 2, 2018 3, and 2019 4. You are further supplied with the following information. The first point says, on 1st April 2016, a major plant repair was undertaken for rupees 10,000, which was charged to revenue. The said sum is to be capitalized for goodwill calculation, subject to adjustment of depreciation at 10% on reducing balance method. The second point, the closing stock for the years ended 31st March 2017 and 2018 were overvalued by rupees 1,000 and rupees 2,000 respectively. And finally, to cover management cost, an annual charge of rupees 5,000 should be made for the purpose of goodwill valuation. So we need to value goodwill based on average profits method using the weighted average. In addition, we need to make adjustments to the profits which have been given. So we'll begin with the solution. We have a table over here. The first column is the year. Second column, profits. The third column, adjustments to be made. The fourth column, adjusted profits. Next, weights. And finally, the product. Let's begin with the first year, 31st March 2016. The profits, 25,000 rupees. 31st March 2017. The profits, 27,000 rupees. 31st March 2018. The profits, 46,900 rupees. And for 31/3/2019, profits are 53,810. We'll begin with the first point. It says that on 1st April 2016, a major plant repair was undertaken for rupees 10,000, which was charged to revenue. Now, when a major plant repair is undertaken, it has to be a capitalized expenditure treated as a fixed asset. But it was treated as a revenue expenditure, and thereby the profits got reduced. So we need to add back the 10,000. 1st April 16 will affect this year. 1st April 16 to 31/3/17. So in the adjustments to be made under year 31/3/17, we will add back 10,000 rupees. Now, since this 10,000 was treated as a revenue expenditure and not as a fixed asset, we would not have charged depreciation. So now we need to charge the depreciation which was not charged earlier. It's given that depreciation is flat rate of 10% on reducing balance method. For the first year, that is for the year ended 31/3/17, 10% of 10,000 is the depreciation, which is 1,000 rupees. Now the written down value is 9,000. For the next year, the depreciation will be 10% on 9,000 rupees, which is 900. So for the next year, I deduct 900. Now the written down value becomes 9,000 minus depreciation of 900, which is 8,100. And for 31/3/19, the depreciation is 10% on 8,100, which is 810. So I'll repeat this treatment. On 1st April 2016, a major plant repair was undertaken for 10,000, which was charged to revenue. So 10,000, which was supposed to be a fixed asset, was erroneously charged to revenue. So we add back that 10,000. And since we did not treat it as a fixed asset but treated it as a revenue expenditure, we did not charge depreciation, which we will do now. The depreciation to be charged is 10% on reducing balance method. So the first year it's 1,000. Next year it's 10% on 9,000, which is a written down value. So that's 900. Then the written down value becomes 9,000 minus the 900, which is 8,100. And 10% on that is 810 rupees. The second point, the closing stocks for the year ended 31st March 2017 and 18 were overvalued by 1,000 and 2,000 rupees respectively. We'll begin with 31st March 2017. So again, it's affecting this year of 31st March 2017. When the closing stock is overvalued, it will go to increase the profits. So I will deduct the 1,000 here. Now the closing stock on 31/3/17 becomes the opening stock on 1/4/17, which will affect the next year. So overvaluation of opening stock will decrease the profits. I need to add back the 1,000 now. Let's do the same thing for 31st March 2018. The closing stock was overvalued by 2,000. So in this year, 31/3/18, we will deduct 2,000 rupees. And the closing stock on 31st March 18 becomes the opening stock for the next year. We need to add back overvaluation of opening stock. So we'll add back 2,000 rupees. The third point, to cover management cost, an annual charge of rupees 5,000 should be made for the purpose of goodwill valuation. So every year we will deduct 5,000 rupees. Now Now let's get the adjusted profits. For 31/3/2016, 25,000 rupees minus 5,000, 20,000 rupees. For the next year, 27,000 plus net effect of the adjustments is 3,000 rupees. So it's 30,000. The third year, 2018, 46,900, and the net effect of the adjustments is 6,900. And we need to deduct this amount, so we get 40,000 rupees. And for 31/3/2019, 53,810, and the net effect of the adjustments is minus 3,810, so we get 50,000 rupees. Let's assign the weights 1, 2, 3 and 4, beginning with 2016. The product, first year 20,000, second year 30,000 into 2, which is 60,000. The following year 40,000 into 3, 1,20,000. And for 2019 it's 50,000 into 4, which is 2 lakh. The total of the weights is 10, and the total of the product is rupees 4 lakh. Therefore, weighted average is equal to sum of product, which is 4 lakh, divided by sum of the weights, which is 10, which is equal to rupees 40,000. And goodwill is equal to the weighted average profits into the number of years purchase which is equal to 40,000 rupees into the number of years purchase is given as 3 in the sum. So into 3, and I have the value of goodwill of the firm as rupees 1,20,000. So we've done a comprehensive example with multiple adjustments using the weighted average and valued goodwill under the average profits method.